Well, one of the Trump trades impacting agriculture in North America is the reduction of the Canadian dollar post-U.S. election. Now, host of Real Ag Radio, Sean Haney, joins us now with the very latest on this. So, Sean, how much has the Canadian dollar dropped, and what fundamentals are driving that?
Yeah, it's great to be with you here this morning. And, I think probably at first glance, you're thinking this is more of a Canadian issue, but it also does impact U.S. farmers as well. And we'll get to that in a second. But in terms of how much it's dropped, it's fallen 2% since the election in earlier this month and 4% since late summer. So if you think back to late summer, it was about 74 cents, and it's kind of in a sideways trade for some time. But now we're just north of 71 cents. And the expectation is it may fall lower. Now, during the pandemic, we did trade below 68 cents, and going way back, most Canadians remember this very well, traded actually at a plus to the US dollar at about 110, but that was some time ago. All this is based on the strength of the US dollar. The Canadian dollar has held up better than some of the other major currencies, but this is all based on the strength of the US dollar, not necessarily weakness in the Canadian one.
That is so interesting. So how does this impact Canadian and U.S. farmers?
Yeah, we'll start off with U.S. farmers, imports from Canada. So if you just got cheaper, right? So those U.S. dollars go further when you are spending money in Canada. Now, possibly that works itself out to something like fertilizer, for example, potash. 87% of the potash that's used in the U.S., it comes from Canada. That might be some pricing help for you there. And of course, there is some machinery, especially in the short line, things like seeders and air carts. A lot of those are manufactured in Canada and are shipped to the U.S. That also may be a pricing advantage for U.S. farmers. Now, for Canadians, import's going to get much more expensive, right? And so think about machinery coming into Canada, some of those tractors from some of those plants in the US, they're going to be more expensive because of the currency working against them. But for Canadian farmers that are exporting goods, so beef and pork, canola to the US, there's a little bit more money in your pocket because all of those commodities are priced in US dollars and they're converted back to Canadian at the farm level. So from an exporting perspective, it's pretty good for Canadian farmers.
Right, I see that. So what is the Bank of Canada expected to do next with this 4% drop?
It's going to be interesting. A lot of the reading I've been doing over the weekend on this is that there is an expectation that the Canadian dollar the Bank of Canada is going to continue to drop rates. But with further rate drops, it's going to bring further weakness to the Canadian dollar and the currency. So a big part of the question here is how aggressive does the Bank of Canada get trying to balance off the currency value and trying to battle in inflation. So it may give them a little bit of pause. And if the Federal Reserve was to continue to drop rates, which is expected, that's also going to help prop up the Canadian dollar a little bit more so than if Canada just continued to drop and the U.S. didn't. So watching the Bank of Canada very closely here, and if this sort of tempers some of their aggressiveness.
Yeah, I was curious if our action by our Federal Reserve had any connection to that. So that's host of Real Ag Radio, Sean Haney. Appreciate that update. You can catch Sean on his show, Real Ag Radio, which airs at 4:30 p.m. Eastern weekdays on Rural Radio, channel 147 on Sirius XM. And we will talk to him again here on Market Day Report tomorrow.